Hello and welcome to the Final Bar. It's Thursday, June 20th. I'm your host, Dave Keller. I'm the Chief Market Strategist here at Stockcharts.com. Today, not from a Redmond, Washington, but on the road, definitely not in a hotel room here from Columbus, Ohio. I'm in town for the Ohio State University Men's Glee Club, which I was in the late 90s. It's the 150th anniversary of that singing group here at Ohio State. So I'm in town for a weekend reunion and concert. So if you're in the Columbus, Ohio area, consider checking out our concert on Sunday at 2 o'clock at Trinity United Methodist Church. But with that in mind, let's get to the market recap and focus on how things played out today. As I was flying from Seattle to Columbus today, following it on the markets, just kind of checking on where things were at. Sort of an opposite day to what we normally experience, right? In recent market history, we have the NASDAQ higher, S&P in the middle, Dow down. Today, that script has been flipped. The Dow actually finishing in the positive 0.8% higher. The S&P 500 down about 0.25%. The NASDAQ composite down 0.8%. You're going to see here as we go through our market recap that overall the weakness comes from some of the leading groups. Technology, which has been the top performer, really struggling to get things done today with some bearish engulfing patterns that are a bit of a concern. Going back here to the major benchmarks, S&P now at 54.73 after the close. And again, that's down about 0.25%. Not a horrible day. So let's be clear. This is not an end of the world kind of day. But, you know, again, in a stretch where we've had just unstoppable up days, one after the other, having a brief down day feels like a pretty big deal to me. Mid caps and small caps both down about 0.3% today. The NASDAQ 100 was down 0.8%, and the VIX actually moving higher, still a 13 handle, so the VIX is still relatively low compared to historical averages in the low teens. We still remain in a low volatility environment. As you'll see here, and we'll get some individual stocks, so there is plenty of volatility, and this is one of those kind of head scratcher moments. A lot of people assume that the VIX means volatility for stocks. And generally speaking, that's usually not untrue. But this is one of those kind of interesting periods in market history based on the structure of the market and what the VIX is actually measuring, that the VIX as defined by the volatility of the S&P 500 index options market, volatility is actually very low. If you look at the volatility of individual stocks, I would say quite elevated here in June of 2024, particularly relative to May. So it is is interesting juxtaposition of high vol and low vol, but overall, focus on the on price and trend primarily. Interest rates overall moving higher today. You can see the 10-year yield finished today around 4.25. The 5-year point just slightly higher, around 4.27. The long bond yield just below 4.4%. The short end of the curve, of course, is still elevated. What we learned earlier in this month from the Fed is that they're not in a hurry to lower rates anytime soon. Rising rates and certainly elevated rates staying higher for longer would tend to be a major league headwind for growth stocks like technology and communication services. It's not been the case. Now, some would argue, myself included, that if and when the market actually tops, and maybe we're in a topping phase already, I think we actually are. I think a summer peak is certainly most likely in the works. What would probably happen if you think about what's been dominating? It's going to be the growthy stuff, the mega cap growth stocks that probably hold up the best for the longest, because those are about as safe of a trade as you can come up with, right? Buy Apple and NVIDIA and just kind of ride this out. So if those stocks start to actually struggle, that's where our benchmarks can rupture quite quickly. The dollar index using the UUP, which is a dollar ETF, it's up about 0.4%. Maybe something to watch there, because we've talked about the risk of a rising dollar, because the dollar has overall not been too much of a story yet. Gold and silver prices both moving higher. Industrial metals like copper higher as well. So copper was up 1.5%, gold about 1.25%, silver almost 4% higher. Energy, generally speaking, was positive, with crude oil up about 1% using the USO, and energy was your top performing sector today. Bitcoin, noisy day over the last 24 hours. It did pop above 66,400. But as we're doing the show here in the evening Eastern time, it's right around 65,000. So essentially flat from where we were yesterday at the quote unquote end of the trading day. These things, of course, trade 24 hours. So there's an almost arbitrary moment during every 24-hour period that is considered the close. And that's a technique that's taken from the currency markets. which do kind of the same thing. So for what it's worth, essentially flat action in Bitcoin after a pretty meaningful spike. But during the equity trading session, kind of choppy, sloppy, but sideways. Ether prices just above 3,500. That's down about 1.4% from yesterday. Looking at the 11 S&P sectors, you can see some, somewhat unfamiliar sectors at the top of the list. Energy, your top performing sector, the XLE was up 1.8%. Utilities, number 2 at 0.9% higher. Financials about 0.5% to the upside. Only 3 of the 11 S&P sectors were down, but most concerning, technology, which was down 1.1%. Now, granted, you could argue with charts like NVIDIA. I don't know who any investor or trader that would not say a stock like NVIDIA needs a break at some point, right? We've had this just incredibly persistent and consistent uptrend. Having said it, doesn't feel very good when NVIDIA is doing a bearish engulfing pattern, as we'll see for a moment. The XLK down 1.1%. Real estate and consumer staples both down about just under 0.25%, I would say. It's worth noting the market trend model that I created and have used now for a while. We run that on a series of different equity indexes. You can also, if you have this on your dashboard as a Stockcharts member, which of course you all should be, but if you are, you have the option of selecting the stocks model, which combines these 4 different kind of cap tiers along with the NASDAQ 100, and then the macro model, which looks at commodities and other asset classes as well. It's worth noting here, I don't formally update my model until Friday's close. However, the small cap Russell 2000 model, if today was Friday, it would actually turn bearish on the short term and the medium term. Talk about a difference from large caps, bullish across the board still, even with the pullback that we've seen here recently, and small caps starting to be really in a danger zone according to my market trend model. Again, I don't like to draw too many hard conclusions until Friday's close, because it's a weekly model that I update every Friday at the close, but worth noting that you're seeing some weakness there in mid caps and especially in small caps. There were stocks that went up today. Don't get me wrong. I'll highlight some of those here as we continue our market recap. It's worth noting Amazon was up almost 2%, handily outperforming the major U.S. benchmarks. Alphabet up 0.7% as well. Now, the big story, of course, are the big technology names, particularly NVIDIA and Apple. NVIDIA was down 3.5%, Apple down over 2%. Now, NVIDIA, of course, has been a long-term uptrend story. Apple has been a refreshing uptrend after the developers conference. I think that was Monday of last week. So a big down day for both of those names. Certainly a lot of market cap. Those are your two of the 3 largest names for sure. Tesla, by the way, down about 1.8%. And Microsoft, the third largest, third of the 3 top technology stocks, slightly down, 0.1% lower. Let's go to a daily chart of the S&P 500 and see how things are playing out here. You can see, I don't know if this is technically a bearish engulfing pattern. We'll take a look here in a minute, but it's when I'm looking at the chart of the S&P, take a step back from your monitor, just reflect on the overall trend. This is still in a primary uptrend, and I would say that is a fact as defined by the general trend in the highs and the lows. As long as we keep getting higher highs and higher lows, there's no cause for concern based on trend, right? Based on momentum and other things we maybe have, and breadth conditions, we certainly could come up with some reasons to not be particularly bullish at the moment. But from a pure trend following perspective, the trend remains quite robust for the S&P 500. I've highlighted this pink shaded area, which is around 5370 to 5400. For me, that is the tactical line in the sand. That's that level that as long as we hold it, there should be nothing to worry about because we are still doing just fine. We break that level, it's not necessarily the end of the world, but it would tell me to start to think about the potential of further downside moves. Other levels that I would be watching if and when 5400 is violated. A trend line using the major lows for the last 8 months is currently sitting around 5300. That actually could theoretically line up with this shaded area if it takes it takes a couple weeks to get down there. But that would be the next level to watch in terms of trend. The 50-day moving average currently around 5225. 5200 is sort of that ultimate line in the sand because that's the most recent swing low. As long as we make a new low above that level, conditions are okay. Now, if you look at a candle chart, it is technically a bearish engulfing pattern. We'll see if the SPY. Yeah, it's not the worst bearish engulfing pattern I've ever seen because it is an up day and a down day. They're not particularly wide ranges, right? Today, the S&P was only down what, 1/4%. I mean, these are pretty small bars. Ideally, the second one is a big down day, and you'll see that on some of the semiconductor stocks. But technically speaking, I think that's fair to label that as a bearish engulfing pattern. And what does that mean when you see a bearish engulfing pattern? It just means that the next 1 to 3 bars are more likely to be down than up. We actually are going to be sitting down with Steve Nissen, who is accredited with, introducing the Western investors to candlestick analysis, which until he kind of got involved, the only books that were written on candles were all in Japanese, and the only traders that really used candlesticks were Japanese traders. He actually visited Japan and took what he learned and wrote about it in English, and that really proliferated. So we're actually going to be interviewing him on some of the candle patterns he watches. Look for that hopefully coming here in the next couple of weeks. We're working out the timing to have a good virtual sit down with Steve, who's based on the East Coast. But we'll look forward to talking with Steve about, and maybe asking about some of these patterns and what sort of timing and structures he looks for. He's about as much of an expert as I could come up with. Now, I have had some questions recently about breadth conditions. To be clear, someone actually mentioned, how come you haven't mentioned the McClellan oscillator in a while? I mean, I've mentioned, I feel like every show that I've done, we've talked about the weak breadth conditions. And so that is a quick way of saying the McClellan oscillator is still below zero. Here is the chart of the McClellan oscillator. You can see we went below zero really third week in May. We have remained below there through the end of May and through the entirety of the month of June. I don't think that's news at the moment. I mean, it is. There's nothing new, right? And that's why I probably haven't made too much of a noise about it. Generally speaking, the signal is when it goes below zero. As long as it remains below zero, these are weak breadth conditions. Now, what's interesting is it reminds me a lot of what we saw in January, which is where we had this beautiful sell signal from breadth after November and December, very strong short-term breadth. The McClellan oscillator went below zero. The market actually took off, and after that continued to strengthen into the eventual March high. And the real downdraft wasn't until April when we had the pullback into the April low. So kind of similar to January, that is, where we've had the McClellan oscillator below zero now for a couple of weeks. We still have the market going higher, and that's because those biggest growth names are still fine. So the market can go higher on weaker breadth. You just need narrow leadership, and you need those narrow leaders to be huge names, which is exactly what we've had. Now, the McClellan oscillator is based on the raw advanced decline data. It just smooths it out with some exponential moving averages as a way of turning it into a short-term oscillator. But we could look at the long-term breadth conditions. You can do that a couple different ways. The McClellan summation index actually takes the McClellan oscillator, turns it into more of a trending indicator. I like to just look at the simple raw advanced decline data. And you can see the New York Stock Exchange AD line, the mid-cap AD line, the small-cap AD line still remain below downward sloping 50-day moving averages. As of today, the S&P large-cap AD line did briefly go below the 50-day, but did pop back above there. So it's actually net positive still. I'm still considering these all neutral until they would break below the April low, in which case I would consider them bearish. Now that they've gone below the 50-day, I would need to see a break above the May high. So at this point, it's neutral until and unless we break below the April low or above the May high. For now, neither of those things really going on. Let me just talk briefly about small caps, because that's where we're actually seeing continued divergence. So when you talk about market breadth, there's different things you can do, right? You can look at raw breadth indicators. You can look at the smaller names and just see how they're moving. And again, the trend in the Russell 2000 over the last 3 or 4 weeks is clearly down, right? The medium-term trend probably still okay. In the long-term trend, it still feels like a general uptrend. However, if you look at the Russell 2000 here more recently, I may qualify that comment and say this is more of a consolidation pattern. I'll have to think about this one a little more. You could call this, I think it would be a stretch to call this like a diamond top. Because this is kind of an outlier. So I think I would label this a symmetrical triangle pattern or a coil pattern. That's when you have a trend and then you have this consolidation, a narrowing of the range, lower highs, higher lows. Basically, the market is telling you that the Russell 2000 ETF is worth around $203 a share. At some point, we're going to break above the upper boundary, in which case the direction of momentum is clearly positive, or we break below the lower boundary. So these lines are pretty key. I'm going to save them right here on the chart. and I'll be watching those. I would encourage you to do the same and look to see which way that breaks. It's hard to imagine that the S&P and the NASDAQ would have dramatic upside if the Russell 2000 is just clearly breaking down. It is reasonable to expect the S&P and the NASDAQ to go up and the Russell 2000 not leading and maybe just kind of lagging behind quite a bit. But if it's going down, if it breaks below, I would see that as kind of a negative sign for the general market environment. Let's finish off here talking about some individual names. Boy, semiconductors in the news, and not for the reason they've been in the news for quite some time here. And I mean the technical news, right? Semiconductors obviously has been one of the strongest groups, and some of the charts like NVIDIA and others are sort of the perfect names to describe the market conditions here, the AI-fueled frenzy that we've been digesting here in 2024. On semiconductor, certainly looked coming out of the April low, because it had not been a particularly strong name coming out of the fourth quarter of 2023. It looks like it may be reversing. However, look at how this played out. Back in December, we failed to get above the 200-day moving average after multiple failed tests. Here in March, another failed attempt to get above the 200-day. Here, maybe the most concerning one, because we failed to get above the 200-day and also failed to get above this swing high from May. So on now gapping lower today, down over 4%. But I think the real story is that we're back below two downward sloping moving averages. We failed to get above the 200-day. The RSI has consistently stalled out around 40. This is a chart in a primary downtrend. Even though it doesn't look horrible, it's really not it's in a primary down phase, I would say, based on objective forms of trend analysis. I think that's a bit of a concern. Let's look at some of the other semiconductor names. So Micron down about 6% today. This is where we're going to start to get into some of the bearish engulfing patterns. Here's the 2-day candle. Yesterday, Micron had what's called a shooting star candle, right? Which is where you have a long upper shadow, a limited or no lower shadow. The open and close are near the bottom of the range. Happens in an uptrend. That's called a shooting star candle. It tells you the next 1 to 3 bars are most likely down. Today, a higher open, but a lower close. So the second day engulfs the first day. That's called a bearish engulfing pattern. If you like that one, you're going to see a couple others. Here's NVIDIA with the same thing, right? An up day yesterday, not the same thing, a little different. Up day yesterday, down day today. I'd say bearish engulfing pattern. Again, it tells you Friday into Monday and Tuesday, semiconductors like NVIDIA and Micron are in a down short-term weaker phase. QUALCOMM, this is actually a less common but very interesting pattern. You call this an evening star pattern. This is what happens in an uptrend. You have an up day. It's a 3-candle pattern. You have an up day, a gap higher, and then a gap lower, and a big down day. So big up day, a gap up to this little candle, and then a gap down. So there's no daylight. There is daylight between these 3 candles, and you have an up day, a break, and a down day. Think of it like, look at the last one, which is NVIDIA, right? Up day, down day, 2-candle pattern called a bearish engulfing pattern. If you add a little candle in the middle, just a little bit higher, that's called the evening star, right? So think of this as just a gap higher with no follow through. And that's why the evening star candle and the bearish engulfing pattern both talk about short-term distribution over 2 or 3 days. So not a good sign. Just to finish off here, a couple other patterns that I wanted to highlight for you. Gilead, not a bad chart. And actually, it's not all bad, because Gilead has been going lower so far in 2024 until this week, where you started to really in the month of June, you started seeing some stabilization. I think the early sign of this was in April, May, June, when you have a bullish momentum divergence, right? Lower prices, higher momentum. That's resolving to the upside. Today's big up move, up about 8.5% today, getting above that May high. I would love to see on Friday if we can get some follow through and sort of qualify or validate the move that we had today. But Gilead, I would say overall, nice bounce higher. Boy, Salesforce.com, I really want to like this chart, because I want to believe that this is recovering after that big gap lower, gapping below the 200-day moving average. So far, that's been the low. And immediately after, instead of gapping down and running lower, you gap down and actually bounced higher. But what's interesting to me is with today's move, you've now established a higher low. So I don't tend to buy stocks in a position of weakness, but taking a shot at a name like this with a stop around 230, this is what I call a natural stop, right? The chart sort of shows you a very clear place where you can limit the downside and maybe benefit from a return to the upside. As a trend follower, I would much rather see more follow through. I'd love to get back above the 200-day moving average, maybe get above the trend line using those previous swing highs. However, if you're more aggressive, if you're more happy buying some weakness, maybe you buy this coming out of the oversold region, making a higher low around 230. Maybe that's your point to get into. Final chart I want to show you is energy sector was the number one sector today. It was actually up 1.8%, by far outperforming everything else. My question, is this really a bullish chart yet? I would argue not so much, right? I mean, if you look at where the XLE is right now on June 20th, it looks kind of like where energy was in November of last year, right? We had gone to a new swing high. We had this short-term downtrend of lower highs and lower lows. We're right at the 200-day moving average. For me, the story is when we get back above the 200-day and get some follow-through. I think here in February and March is where we're a lot more constructive. You draw trend lines off of these highs, and those trend lines have all been broken. You draw a trend line on the chart of the XLE. I don't know how you're going to draw that trend line where it's broken yet, because for me, I mean, at best, I mean, that's what you'd have to draw, right? So at some point, the XLE energy gets above that trend line resistance because oil prices are starting to push above $80 a barrel. That's what we need to see, as we've mentioned many times, to propel energy stocks higher, to make energy seem like a pretty good bet. Energy companies are basically gaining value, generally speaking, from expectations for oil prices. So if we think crude oil is going up, energy stocks tend to be a pretty good bet. We're starting to see a move higher in oil, with oil pushing above $80 a barrel. XLE is constructive, number one, if we find support at the 200-day moving average. Number two, if we can break above trendline resistance. Number three, let's see the RSI push above 50, maybe even above 60, and start to see some upside follow through. For now, I'm not yet convinced. Folks, that's it. Thanks so much for joining me today for the final bar. Thanks for being patient with us today. I had to travel out here and wait to get to the hotel to do the show. So apologies, it's a little later than normal, but I hope that the show helped you make sense of a day today. An interesting reversal day for some big cap tech. And I would encourage you to pay close attention to those candle patterns and the next moves Friday and into the beginning of next week. For Stockcharts.com, I'm Dave Keller. Be well, stay safe, have a good night.